Hey everyone, welcome back. In this video, we're going to talk about S corporations. They're one of the most popular structures for small and mid-sized businesses, and for good reason. But there are also some important details people tend to overlook, and if you don't know about them, they can come back to bite you. First though, a disclaimer. This video is for educational purposes only. It's not tax or legal advice. Every client is different, and you need to talk with your own professional about what makes sense for your situation. With all that said, let us dive in. The biggest reason business owners choose an S corporation is payroll tax savings. Here's how it works. As an S corporation owner, you split your income into two parts. There's a salary that you pay yourself for the work you do, and there's distributions you take as the owner. You pay payroll taxes on the salary, but not on the distributions. So if you set this up correctly, this can save you thousands of dollars each year in self-employment tax. But here's the key. The IRS requires that your salary be reasonable. That means it has to make sense for the work you actually perform, your industry, your experience, and the time you spend in the business. It's not about picking a percentage of profit or using the Social Security wage base. Those rules of thumb you hear online are not supported by IRS guidance, and they can attract audit risk. Reasonable compensation is based on facts and circumstances. It is not based on formulas. So it's important to document how you arrived at your salary using market data, comparable roles, and a clear rationale. Keep that documentation in your corporate records. It's really important. At our firm, we actually license a specialized tool to help clients calculate reasonable compensation. It uses industry data, job responsibilities, and company details to determine a documented report showing how the number was calculated. One more big point, you have to actually run real payroll. That means regular paychecks, quarterly filings, and timely deposits of payroll taxes. You can't just skip payroll all year and then issue yourself a lump sum W-2 or 1099 in January. The IRS doesn't consider that proper compensation. Better than nothing, but it's not proper, not the way you want to do it. Catch-up payments for prior years usually won't fix the problem, especially if payroll tax deadlines have passed. We do get asked sometimes, what if I own multiple S corporations? Each S corporation in that case stands on its own. The IRS expects you to evaluate reasonable compensation separately for each company based on your role and the services you provide to that specific business. You can't just pay yourself from one entity and ignore payroll in the others. A few pitfalls to keep in mind. First, loss limitations. If your S corporation has a loss, you can only deduct on your personal return if you have enough basis, essentially what you've invested in the company plus any retained earnings. If you don't have enough basis, those losses get suspended until you build up enough basis to take them. Second, compliance. An S corporation comes with more administrative work than a sole proprietorship or a single member LLC. You've got to run payroll, file quarterly payroll reports, file a more complicated tax return, and keep up with corporate rules. That's part of the trade-off for the tax savings. There are also a bunch of other things to consider that we don't have time to cover in a short video, like owning real estate, impact on SEP plans, impact on inheritance, and similar things. So it's not something you want to jump into lightly, but when does an S corporation make sense? Usually once your business is consistently profitable and you're taking home more than you'd reasonably pay yourself in salary. At that point, the payroll tax savings can justify the added complexity. If you're just starting out or your income is still unpredictable, it might be better to wait until things stabilize. So let's recap. The main benefit is payroll tax savings through the salary distribution split. You must pay yourself a reasonable, well-documented salary that's non-negotiable. You need to run real payroll and stay compliant with filing deadlines. We can help clients calculate and document reasonable compensation using a specialized tool backed by industry data. Retirement contributions can be optimized with intentional planning, and be aware of pitfalls like basis limits on losses and the compliance burden. That's it for today's video. Next time, we're going to wrap up this series with a potpourri of unique strategies, things like medical reimbursements arrangements through a C corporation, Puerto Rico tax incentives, and captive insurance companies. These aren't for everyone, but in the right situations, they can be really powerful tools. And remember, if you're a client and you want to explore S corporation planning in more detail, let's talk. If you're not a client, but you're running a successful business and want to see how we might be able to help, feel free to reach out. Thanks for watching, and I'll see you in the next video.